Welcome to this edition of the Commercial Real Estate 101 meetup group, where we talk about different topics pertaining to commercial real estate and really business ownership, because that's business owners are ones that deal in commercial real estate. So it's something that I think could be very valuable for these topics are very valuable to business owners and investors as well. So today I thought we'd bring in Nicole and Kent from Strothman Co. We've had actually Strothman come by a few months ago at our other meetup, which was the Louisville Small Business Summit, to talk about PPP forgiveness. And today we talk about, I thought it'd be great for them to come by and talk a little bit about the commercial tax strategies for both business owners and investors. So thanks again for stopping by, guys. Really do appreciate it.
Thanks for having us.
Yeah, no, for sure. So generally speaking, when we have people on the meetup, we like to learn a little bit more about them and their background. So I was wondering if maybe you could both of you guys could provide us with a little bit about what brought you into your line of work.
For sure. So my name is Nicole Jarboe. I'm with Strothman Co. I've been there for about 2 years. As far as the accounting world goes, I've always been a number person. So it just seemed like the logical thing for me to do. But as real estate, my interest in real estate peaked when my father started a business in construction, and then he started buying rental houses and flipping them when they were low value. He would fix them up and everything, and then start renting them out. And he's got about 10 houses now. So I've always seen like the residential real estate side of everything. Commercial real estate is definitely different than residential, no doubt, but it's an interesting concept. And then taxes, as far as taxes go around it, there's all kinds of different strategies out there.
And Kent, you want to kind of give us a rundown?
Yeah, I'm Kent Nostitz. I'm a advanced staff at Strothman Co, and I've been there for about almost 2 years now. I'm also on the real estate segment with Nicole. We have a group of 6 or 8 of us that focus on our real estate clients. So it's always good to, Strothman is segmented, and we try to focus on becoming professionals for our clients in these industries. So it's good to be here today. Thanks, Raphael.
Definitely, of course. And Ken also is on the Young Professionals Board for JA. So I serve on that board as well. So it's good to see him there as well. And I'll kind of, yeah, of course. And I'll kind of echo that as well. I mean, and in particular with commercial real estate, because there are so many different types of commercial property. So really the specialization portion of commercial real estate is something that is important. So. All right, so what we'll go ahead and do is we'll go through a list of questions that I kind of share with you guys, and then we'll kind of open it up for Q&A at the end. So as far as, yeah, of course. So as far as people who are interested in any type of either business or investing of real estate, why should they hire an accountant? I mean, what is the value of conversing with an accountant regarding their real estate needs?
So at the end of the day, we try to save our clients money from, instead of paying taxes, they can use that money to put back into their business. So that's probably our main goal. And there's a lot of different ways that we do that using the tax law, and so I think a couple of items that that's important for us to use for our clients is, hold on a second.
I think the main reason is that the tax code is so complex. Even as professionals in our industry, we're still constantly keeping up with the code because it's always changing. So we go to CPEs all the time. We are required to get so many hours, especially once you become a CPA. So you want to, if you have an accountant, you're paying for that expertise. You're paying for efficiency, so you can take your time and your money and reinvest it in your company.
Definitely. Yeah. And I agree with that. I mean, that's the reason why I deal with my accountant on a regular basis, is because, I mean, I'm an expert in my business. I'm an expert in my whatever I'm investing in. I'm not necessarily an expert in the tax law. And as we were talking about before we actually hopped on, I mean, related to PPP, but really related to the entire tax code. I mean, there could be changes coming down the pike that in reality, I mean, we really don't know. And as an accountant, that's really your guys' forte. So anytime you're dealing with a sophisticated type of transaction, like either commercial real estate or even in your business, I think it's important to kind of have an accountant on your side to be able to advocate for you. So I definitely agree with that. So I guess one of the major parts of dealing with an accountant is tax planning. Could you kind of tell us the importance of tax planning for business owners and investors?
Ultimately, you want to tax plan, even if you're just doing your individual taxes, but especially when you have a business, because you want to maximize your tax deductions. You want to, at the end of the day, reduce your taxes to that lowest point that you can so you can reinvest that money, use it wiser. But one of the main reasons you want to plan is if you end up owing too much at the end of the year, you can face penalties. I know for individuals, if you owe over $1,000 and it's not in your percentage compared to your prior year's tax, that's a whole nother story. But if you owe over $1,000, you get penalized because the IRS, they're going to want that interest on that money because technically you should have been paying in quarterly. So if you're not paying in like you're supposed to, they want that time value of money back. So as a business, you just want to plan it out, make sure everything's set in stone and that you're okay. We'll talk about it a little bit later as well, but you like say you have a large purchase that your company's thinking about, like a big machine for production or something. You want to consult with your tax advisor and see if the timing of it is good for in December or in January, should you push it off to next year. It could be the result of that transaction could end up affecting how much you pay in taxes for the year.
Definitely.
Yeah, so I think timing is a big thing when it comes to looking at tax planning, and you just don't want to be surprised at the end of the year saying, oh, well, I thought I was going to owe X dollars and I owe 3 times that. So that can really throw a wrench in next year's business operations. So being able to tax plan for the current year and future years is important.
Oh, for sure. I mean, cash flow is king in business. So if you're getting a massive expense at the end of the year that you weren't expecting, I mean, that could really hurt you as a business owner, because if you don't have the cash on hand and you have other vendors you have to pay and various other things, that could spell trouble. So I think it's important, like you said, to really sit down with an accountant in particular. I mean, periodically throughout the year to make sure that you're in line with what you're expecting at the end of the year. And then going forward, if you have expansion plans or whatever else. So that's some great advice. So as far as some of the tax strategies are concerned, I thought we'd kind of dive into those. So what are some of the most common tax strategies that you think are overlooked from a business owner's perspective? And we'll kind of get on the investor side in a second.
Tax strategies relating to real estate that I think are overlooked and actually have a positive tax advantage and business advantage are cost segregation, like-kind exchanges, which I think we'll hopefully talk about later. Opportunity zones is a new one that is proven to be successful. And then something that one of our clients that piqued my interest is one of our clients is doing a 45L tax credit study. And this is a credit for basically energy efficiency and the new developments. And I think there's some rules that you can use it. So if you didn't take it 4 years ago, you can take it this year. And that's up to $2,000 per unit. So if you're building energy efficiently, that is something to look at.
Do you have anything to add to that, Nicole, or are you, as far as the business owner side of things?
Yes, everything kind of interacts in the real estate world with business owners and investors. Mm-hmm. So I was kind of going to mention just you want to hold, yeah, this definitely relates to both of them, but you want to hold your properties for more than a year. definitely, because you want to be long-term. Long-term is holding a property for more than a year. And if you're short-term, you can end up paying taxes. If you have a profit, you can end up paying taxes at your ordinary taxable income level, which is typically a lot more than if it was a capital gain. So if I buy a property and I turn around and sell it in 2 years, and I have a profit, I'm going to pay capital gain tax on that. It depends on your income level and everything, but typically it's around 15%. So you want to pay attention to that. Timing is everything for sure. Also, your 1031 exchanges, which are like-kind exchanges, you want to, we'll talk about this later, but basically reinvesting profit to avoid paying taxes immediately. Installment sales, maximize your deductions. A lot of people think of the typical things, but you also want to pay attention to like any mortgage interest you pay for, insurance, property tax, depreciation is a huge thing. I know we'll come back to that too, but there's all kinds of things out there that people can miss.
Awesome. Thanks for that. So I guess that was kind of related to the next question, which was related to the investor side of things, which is fine. So really what I think you guys were really focusing on are different tax strategies in order to save you in the sale of real estate, which is very important. And we're kind of dive into those as we follow along in these questions. So awesome. So I guess this is one of the concepts that gets talked about a lot in real estate, which is the concept of depreciation. Can you kind of talk a little bit about what depreciation is and why is it a benefit to people who own commercial property?
Absolutely.
Yeah. Oh, go ahead, Nicole.
So depreciation defined by the IRS is capital expense that is the mechanism for recovering your cost in an income producing property and must be taken over the expected life of the property. So if you buy, even in just ordinary business, if you buy a truck, that expected property is going to last more than a year. So you want to expense that property over the life of the asset. And we'll talk about bonus and everything, which there's opportunity for you to immediately expense that out there right now. But you want to reduce your income tax by expensing your assets over the life of them. You can do accelerated depreciation like bonus 179, etc. You basically get the opportunity to, I guess I essentially said it, if you buy a $200,000 machine, you don't want to expense that immediately this year. The IRS isn't going to let you do that sometimes either. I know it's not, depreciation isn't just for real estate, but as far as real estate goes, if you buy a piece of property, you can depreciate that building, improvements to the property, qualified improvement property, which is 15 years. The building in commercial real estate is 39 years. But you can depreciate almost any improvements to that property besides land, because land doesn't, the value is always there. Your building, say in 20 years, you're going to have to put a new roof on it or something. You can't just depreciate land because there's no, other than like maybe putting some pavement down and having to replace that, there's no real changes in your land value.
Yeah, so I look at depreciation and real estate as one of the most valuable parts of real estate, because you're expensing something that is appreciating, and not many businesses, we'll use a restaurant for example, not many tools in a restaurant appreciate in value, or if you think about any other industry, not many things appreciate in value, and the IRS lets you expense that in pretty large increments. So I think and that plays back into cash flow in the real estate world. So you're gonna have more expense and recognize less income, which leads to higher cash flow.
Definitely. No, I agree. And I mean, especially like you said, it's about shielding some of the income that's produced by the building. And I know we'll dive into this other strategy later, but you're able to shield part of that income over that 39.5 year period. Or if we're diving into cost segregation, you can kind of isolate those components of the building and do that as well. So definitely a huge strategy for people who are looking to purchase commercial property is the depreciation of the actual asset. But like you said, you cannot depreciate land because realistically there's no normal wear and tear on land. It's really just you're focusing on the improvements, which would be the building value. So if a piece of property is $300,000 and the building's assessed for a $200,000 amount, then that's what you can depreciate over time. So awesome. So then, go ahead. I'm sorry.
Just to add to that, most, I would say the majority of larger real estate is funded by debt. So you're kind of double dipping there. You're not paying money. You're not paying that huge lump sum at one time, but you're still able to expense that depreciation. So it's definitely advantageous.
Yeah, and that improves your after-tax return, which we could get into a whole finance lesson here, but it's really, it can be extremely powerful if you're able to leverage debt in order to purchase the property and then depreciate the entire value of the building for your cash flow after debt service and everything. So it could be very, very advantageous for sure. So I guess the next question, which kind of leads off the depreciation route, is that generally speaking, if you were just going to buy a commercial property, you'd be able to depreciate it over the 39-year period, which you guys were mentioning. But is there a situation where you can optimize the depreciation of that building? And I think we're going to reference it as cost segregation. Can you guys kind of elaborate on that a little bit?
Yeah, so I think cost segregation, from what I see, is one of those things that our client, more people should use it in the long run. It is having a study by some engineers and some people that know the field, and they basically take your property and they're going to break it up into, I don't know, hundreds of smaller things. So we're going to say this piece of furniture, your basement steps, they're basically breaking it up into components. So they're going to say the land is worth this much, your 1250 property is worth this much, and your 1245 property is this much. So you're going to be able to take a large amount of depreciation once it's broken up this year. So for example, I just worked on a client. They had it wasn't a commercial property, but it was a residential single family home. And I think they paid around $300,000 for it, and they did a cost segregation, and they were able to depreciate about $100,000 this year. So I mean, it was a substantial amount, but I think what deters people is that these cost segregation costs a little bit of money. The bigger the property, the more expensive obviously it's going to be. But I think the savings, and that's one of those things that consult with your tax advisor on. Is the savings going to be greater than the cost of the study?
Yeah, we have a few myths that we researched. So does cost segregation increase your audit risk by the IRS?
Oh, and no, it doesn't increase your audit risk by the IRS. What you do want to use is a reputable cost segregation company to come in with licensed engineers and stuff to do this study. If you're just kind of using market data to use this, yes, your audit risk probably, your risk does go up a little bit.
Yeah, and then your engineering study fees are too high.
And that's false because the IRS Circular 230 prohibits performance fees. owner, I'll throw out a finance term here. Owners see a ROI on fees 8-to-1 over 200-to-1.
Which is your return on investment for those who don't know. Ultimately, this is not going to produce a big saving, just a timing difference.
Yeah, so cash flow is definitely king, as we've said. Time value of money, you always have to think about that. And then does the seller get burned with high tax upon sale? No, you can use 1031 exchange. It's a win-win. Also, it plays in fact, if you want to do a cost seg, if you're going to keep this property for a long time, or it's just a short-term thing. So those are some things to keep in mind for cost segregation.
And that comes into play with planning, right? With tax planning, as you're going through the process of working on acquiring a property and you're determining whether or not it's beneficial to do a cost segregation study, it's probably wise to include your accountant in the discussion to make that determination for you, to help you make that determination.
Yeah, it's just not something you just want to say, cost segregation is going to benefit me. It may not, but there's I'm going to say, good chance that it probably will.
Definitely. And like you guys were saying, it doesn't absolve you from the tax obligation when you sell the property, unless you do something like an exchange where, you just pass along the funds of the acquisition, or the funds of the actual transaction, into a new building, like-kind building, which we'll dive into later. So definitely ways to accelerate the depreciation of the property. And then on the back end, if you do a 1031 exchange, you can continue to move forward those gains. So awesome. So now that we've kind of discussed the cost segregation side of things, can we discuss a little bit about bonus depreciation? And I mean, from my understanding, it applies also to other things, not just real estate.
Absolutely. You can take bonus on almost anything that you're depreciating, besides some property like building and everything. But bonus depreciation is a tax incentive that permits owners of qualified property to immediately deduct a percentage of the asset's depreciable basis. Right now, the qualified assets are deductible at 100%. This is expected to change after 2022. They estimate that this percentage will decline, but you never know what the future holds. So I think if you buy an asset now, ultimately you want to plan. You want to buy your assets when you feel that you can get the best bang for your buck. And in that being that you don't end up paying taxes on items that you shouldn't. So if you're going to buy a $200,000 piece of equipment or a commercial building, whatever, you want to do it when the timing is right. So Kent, did you have anything you wanted to add to that?
Yeah, so 179 is definitely a powerful depreciation tool to use. It kind of ties into the depreciation that we talked about before. Same kind of principles. It's just it's kind of called something differently. It has a few different rules, but you definitely want to take advantage of putting as much stuff, bonusing as much stuff as possible in the current year and in future years.
Yeah, and then recently the Tax Cut and Jobs Act expanded the bonus to like non-residential roofs, HVAC systems, fire suppression, fire alarm, security systems. And then you get into your qualified improvement property, which is 15 years. It's a little bit different. But as far as commercial real estate, you can't take bonus on like your actual building because it's 39-year property.
Yeah, definitely. But it applies to other things. So for business owners, for example, if let's say you're looking to expand your fleet, you're a contractor and you want to expand your fleet of trucks or whatever. I mean, that could be an opportunity for you to capitalize on that. And I know I know some business owners too that do this, like you said, near the end of the year, to be able to capitalize on that. They're just like, well, what do I need to do in order to help with my tax obligation for the year? And they'll say, well, do you need to buy these certain things? Then this may be a good opportunity for you to kind of take advantage of that on the back end. So
Yeah. And then as far as when assets are placed in service, you also need to look at, I know I don't have the specifics because I forgot to review this before, but if like over 50% of your assets are placed in service in the fourth quarter of the year, your depreciation may be limited based on when the asset was placed in service. So you definitely need to pay attention to that as well.
awesome. That's great. That's great advice. I did not know that. So that's great information to have. Awesome. So kind of to round out one of the tax strategies that we talked about earlier is a 1031 exchange. Can you kind of explain what exactly a 1031 exchange and how the process works such that you're able to save tax obligations on the back end?
Yeah, so it's basically something in the tax code that allows you to defer your gains to later year. So it used to be you can trade, swap automobiles, and that would be an exchange. You don't have to recognize that. But the only thing that they cut all that in the Jobs Act. And now the only thing allowed is property, like real estate property. So it applies to commercial real estate. So if you're saying, I don't want to be in this, I want to move from Indiana to Kentucky, but I don't want to have to pay gain on my property, you look for somebody else. I think there's companies out there that match people up and saying, do you want to come over here, and I'll come over here, basically, and you're basically not going to recognize gain until you sell your new property. So that's definitely it's a gain deferral tool to use, which if you don't have to pay tax now, why would you? So,
and if you work it in right, plan it out, tax planning is key. You can ultimately just keep reinvesting, keep making those like kind exchanges, as long as it's still in the tax code, but you can defer those profits as long as you want to.
And from my understanding too, I mean, and this is what a lot of people do, is you'd be able to move the gain over and over and over again. And then if you pass on, you can always, the basis will reset for your heirs as well. So that's one of the things that over time, as far as estate planning is concerned, it can be beneficial. Whereas, you've been passing along this gain for your entire lifetime. And then when you pass along the assets to your heirs, that's resets the basis. Thus, when you sell the property, you don't have to realize the entire gains that you've developed over your entire lifetime. So,
you want to look at it like property values are always going up; they're increasing every day, for the most part. But like if you buy a piece of property for $100,000 and you hold it for 30 years, like the value in 30 years is going to be crazy compared to your basis in it. And then if you have depreciation, your basis is going to be even less. So you're going to see that high profit and have to pay capital gains tax on that. So if you plan it and you have children you can pass it on to, that's probably the best option.
Definitely. No, of course. And for those of you who don't know the structure of a 1031 exchange, it, generally speaking, is you'd identify a property within a certain time frame, few properties, and then you'd have to close on them within 180 days. And if this is something that would be interested in, I mean, we can talk about it more in detail as an opportunity, because it is one of those things that's kind of sensitive from a time perspective. So awesome.
There are some rules that you do not want to mess up. Otherwise it'll mess up the whole exchange. Like the timing, that's one thing that you don't want to come down to the wire on. So
yeah, and the qualified intermediary, so you can't just tell your mom, hey, hold these funds for me while I'm transferring over to another property. It doesn't work that way. So it's one of those things where it's a delicate transaction, but again, it's one of the best for real estate investors out there, especially to defer the gains into the future. So definitely a great strategy.
Yep.
Now, there are some situations in which case investors may be just done owning real estate. It's one of those things where you've owned it for a long time, you've managed the property, and now you're like, okay, I don't really want to have to exchange this into another property. And so there's another strategy that we can talk about that's kind of related to an installment sale. Can you kind of explain what that means and then why it may be beneficial given whatever their goals are?
Yeah, for sure. So to me, when I think about installment sales, I think about rent to own. That's essentially what you're doing here. Sometimes you don't have to go through the bank. Say you're my landlord and I'm like, okay, I want to buy this house, but I can't pay you $150,000 today and I can't get a loan. So how about we set up a system where I can pay you $1,000 a month, and you agree to it. So essentially, you're going to retrieve the your cost back in that building, but it's going to be over the 15 years or something. Think it like a mortgage, but you're the bank. So what you're doing in this situation is the benefit of your present value of your tax obligations. So say you're only going to make $12,000 this year, then you're going to make $12,000 next year. You take out a piece of your basis as you're doing it. So you're only going to pay capital gains on a portion of that every year, instead of being hit with that whole capital gain in 1 year. The installment sale under the IRS code is defined as the disposition of property where a gain occurred, not a loss. You can't have a loss on an installment sale. And there's some other small details there. You can't just give your kid a house and say they're paying you $600 and you're not making any money off of it. Like, there are some actual rules around that situation, but you receive at least one payment by the seller. The seller receives at least one payment after the tax year in which the disposition occurs. So it is longer than a year term. And then the installment method of reporting is mandatory in the case of an installment sale. So there's a form that you have to fill out and everything. However, a taxpayer may elect out of the installment method. You do have to receive, lost for words here. You would only do this when it provides a favorable tax benefit to you. So tax planning at the end of the day is important, because there is a lot of bookkeeping. You have to keep records on this stuff you should always keep records for everything, but in case you are audited later down the road. They're not installment sales. You need to keep in mind they're not right for every real estate transaction. You just, if you need the cash today, obviously it's not a good option. But if you are, like what you said earlier, if you're looking to get out of the real estate business or this piece of property, maybe it is the good thing if you don't need the cash immediately.
Yeah, so depending on how much you defer, if you say, I'm going to do $10 million, pay you $10 million this year and pay you $2 million over the next 5 years, you are going to recognize most of your gain this year, but you are still deferring some gain down the road. So it just depends how it's agreed upon. It can be a leveraging tool in negotiations. So it is more of a short-term gain deferral tool. But at the end of the day, you are still going to pay the same amount of gain, just over a longer period of time.
Definitely. And in these installment sales, I'm assuming you can also agree on an interest rate. For example, if you were to have some sort of agreement with the person and say, look, you can pay me 20 grand now, and then over the next 10 or 15 years, you pay X amount per month at a certain interest rate or whatever else. So.
Oh, absolutely.
Yes.
You're in this situation, you're acting like a bank.
Yeah.
So you want capital gains on your money. definitely.
Yeah. So as a general rule, if you have if you don't need the cash and you have free cash on hand that you don't really need it, it is a good tax strategy to use.
Yeah. And if you just, some people that I've talked to, they like the fact that it's just income, monthly income that's coming in. And I mean, they still hold a lien against the property. So if for some reason they decide to back away and they can't pay, then they can always, take control of it again. So it's one of those things where it's like, it's backed up by a piece of real estate. They act as the bank. They can afford to act as the bank, and they have some consistent income coming in over a period of time, which is for them fine. They don't want to deal with the active management of the property, or maybe they're a business owner and they wanted to have someone else take over the building that wasn't able to afford it. Maybe it's one of their employees that wants to take over the business and they just don't have the money to buy the building or something. That could be a good opportunity for them as well, to be able to give them an opportunity but still keep the asset just in case they can't comply with whatever the terms are. So that's awesome. All right. So yeah, that's kind of all the preset questions I had for you guys. Do you have anything in particular that you wish that I asked you that you think the audience could gain some value from?
I did have one thing to say on the 1031 exchange. The new there are if you look up Joe Biden's tax plan online, there are some hard and fast things that he wants to do. But on the 1031 exchange, it is, I don't know if he said it or one of his people that work for him said it, but he wants to get rid of the 1031 exchange for taxpayers making over $400,000 in annual income. So this will definitely be a big hit for a lot of people if it goes through. But that being said, who knows what the future holds, if the legislature will take it up. I guess there's so many unknowns this year that will continue into next.
Yeah. And
he's also, sorry.
No, go ahead. Yeah.
He's also looking at increasing the capital gain tax to 39% for taxpayers making over 400K annually. So I think we definitely need to be on the lookout for what actually goes into effect from Biden.
Yeah, so that comes back to tax planning. Is it smart to recognize that gain this year, so deferring to next year and not knowing if that will change? That's something that is going to vary from individual to individual. So I think that's most of the real estate things that he talked about changing in the tax code.
Yeah, definitely. Yeah, and I'm assuming that 400,000 is that adjusted gross income. Does that include?
Well, I'm not sure about that because there's nothing
set in stone yet.
Yeah, no, that makes complete sense. Yeah.
I think there's a lot of speculation on what the details look like. So I would probably assume it is. So
yeah, that makes sense. Yeah. Well, it's something to keep in mind, and again, tax laws constantly change. I mean, the 1031 exchange, from my understanding, wasn't even around until relatively recently. So, just because if, let's say, unfortunately, the 1031 exchange goes away, there may be something else that comes around that can be an opportunity for investors to kind of defer some of their money into the future. So it's something to keep in mind for sure.
Yep. People think like, oh, we're gonna make the tax code simpler. We're gonna make it easier. And throughout history, I think especially our partners and managers, they've been there a long time. They're like, it just grows with every year. It gets more complex. There are some things that are new, some things that roll off. So it just varies so much.
Oh yeah. And again, that's why it's so important to have professionals like you guys to be able to advise, because again, it's a full-time job. It's something that you guys obviously have dedicated your time to and have become experts in. And that's a reason why you hire professionals to be able to help you with these sort of things. And not taking that into consideration early on is very short-sighted, because it could really hurt you down the line and you may not even know it. So it's one of those things that I definitely advocate for using, surrounding yourself with strong professionals in all the different industries. So that's awesome. So I guess what we'll go ahead and do now is we'll open up the chat to any questions that you may have. And then I will also be checking Facebook to see if there's any responses on there as well. So feel free to go ahead and shoot your questions over to us. Okay, so I'm not looking like any currently. Let me check Facebook real quick. Okay, so I guess doesn't look like there's any other questions about the tax strategies we just talked about, but I guess I just really want to thank you guys for stopping by. I mean, you guys provide a ton of great information, and again, we always record these videos to be able to share with people. So hopefully people can consume this into perpetuity. And I really appreciate you guys stopping by. And once we do start meeting in person, I'd love you guys to come by and kind of, I'll introduce you to some of the people that kind of stop by all the time. So
Absolutely. Thanks for having us.
of course, yeah, it was great seeing you, Nicole, and see you, Kent. We'll see you at the next meeting.
All right. If anybody has any follow-up questions, feel free to reach out to.
Oh yeah. By the way, I meant to say this. How can people contact you? Do you mind sharing that information so they can reach out if they have any questions?
Yeah, so you can reach out.
We're available on LinkedIn or our emails. Kent, what were you going to say?
Yeah, or we can call the office. There's 1,000 different ways these days.
Yeah, I can include your guys' LinkedIn profiles below. So for the YouTube video, I'll go ahead and post them in the description so people can reach out to you guys individually. And then, yeah, I mean, just again, thank you guys so much for stopping by, and we'll see you guys next time.
All right. Thank you.
Appreciate it. Thank you.
See you guys.
Thanks, everyone.
Bye.